Good morning and welcome to this Wednesday, September 8th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Currently, we've got futures down slightly. The Dow had a rough day yesterday. We're going to go through that in just a couple minutes, but Dow down 260 points yesterday. Down another 13 in pre-market futures, S&P futures down 2, NASDAQ futures down 3.5. So we'll see how we open up. Those are a little bit delayed. Those are probably from about 10 minutes ago or so, but not big moves this morning. Not a whole lot of economic news out. So I think, and earnings news slowing down. So I think the market right now is just trying to find its way. We are in the more difficult period here in September, although the second half of September historically tends to be worse than the first half of September. Things really tend to get going on the negative side around the 16th, 17th of the month. So we're talking about this time next week. Of course, today is the 8th of September. So we've got probably toward the end of next week, maybe next Thursday after the close, Friday. We'll see what the market looks like, but just keep in mind, even throughout this bull market, I mean, September hasn't been that bad of a month during the bull market that we've been in for the last, dozen years, 10, 12 years, depending on when you want to start counting. But off of the low in 2009, September hasn't been that bad of a month, but it has still been rough in the second half. So just keep that in the back of your mind as you're approaching the market. All right, let me go ahead and take you over to Earnings Beats. For those of you who are new, we do have a free newsletter. Let me go over to our homepage here. We have a Earnings Beats Digest newsletter. So if you are new to Earnings Beats, love to have you join our community. No credit card required. You can unsubscribe at any time. 3 publications per week, Mondays, Wednesdays, and Fridays in the mornings, generally before the market opens, typically right around the 8:30 time frame Eastern, maybe about an hour before the market opens. But we'll focus on stocks that we think are interesting. Could be based on relative strength, could be earnings, could be this morning was on gap support, key gap support from earnings. So just a lot of the things that we like to talk about at Earnings Beats. So if you want to learn a little bit more about how we approach the market, this would be a great way to get started. So simply go to our homepage at earningsbeats.com and then scroll down. You'll see the free Earnings Beats Digest here. Fill in your name, email address, and we'll get that started for you. All right, let's move on to what happened on Tuesday. So we had the Dow Jones Industrial Average down 269 points, S&P 500 down 15, NASDAQ up 11. So we did have a little bit of a bifurcated market, although you can see mid-caps, small caps both down about, mid-caps down over 1%. That was the worst performer on the session, and small caps down almost 1%. Looking technically, if there's a little bit of damage, I would say it's on the mid-caps where we fell back below the 20-day. Also, the Dow Jones did the same thing. Dow Jones, though, I think is more in consolidation mode. We got up to that 35,600 area, new all-time high. And since then, we hit the 50-day, couldn't quite get back up to the high. Now I just think consolidating. I would be looking back down, actually, being in the month of September, if we do see weakness later this month, I'd be looking down at these prior lows, 33,300 up to about 34,000. I mean, I'm not looking for the market to sell off that much, but if it did, it wouldn't be that big a deal based on the pattern if we were to go back to that area. The S&P 500 has been much stronger on a relative basis. We still have another 37 points or almost 1%, about 0.8% down from the current price down to the 20-day EMA. So no big problems there. The NASDAQ, which came off 50-day test, turning up. I mean, that PPO looks really strong. The AD line strong. I just don't see a whole lot of weakness coming for the NASDAQ at this point. And then the mid cap, small caps, like I said, it struggled a little bit yesterday. They look a little bit weaker on a relative basis. Looking at the sectors, there were 3 areas of the market that were up higher yesterday, finished higher. And on a down 270 point day on the Dow Jones, pretty interesting that the 3 groups that were up were discretionary, communication services, and technology, which in my opinion are the 3 most important, the 3 I watch the closest, the 3 that tend to perform the best during secular bull markets. We saw some profit taking yesterday in many areas of the market, and yet the 3 aggressive sectors that I watch closely were the only 3 that were actually higher yesterday. If you look at what led to the downside, well, it's these 4 groups. Industrials down 1.7%, utilities 1.3%, staples 1.15%, and real estate 1.11%. So not great action, but all of the groups are still in uptrends. And that's the key when you look at a secular bull market. Secular bull markets pretty much carry everything with it to the upside. So even though we might have seen some weakness here in industrials, and this has not been a very good group of late, utilities, staples, and real estate I've been talking about, I think this could be a group that you want to be careful with in the short term. But these 4 groups are still all in uptrends. And that's what's important to realize as we go through periods of weakness, the market just rotates back and forth. So no one group or no areas simultaneously lose major support at the same time. So you just kind of have to keep everything in perspective. The market continues to look very strong. We've gone through the summer. We're not quite all the way through. The period that I like to watch closest, the weakest long-term period, if you will, during the year historically is from July 17th to September 27th. So we've still got the next almost 3 weeks within that period. And I would say the worst period within that entire July 17th to September 27th stretch is the 16th to the 27th of September. So we still have that coming up, but market couldn't really look a whole lot better given how far we've come up going through the summer. Market continues to defy all odds, keeps moving higher. 10-year Treasury yield. Let's get an update here. Just flat, actually. Let me see here. I've got the 10-year Treasury down about 2 basis points, 1.35%. Not sure why it's not showing up here on this chart, but we are down just slightly on the yield this morning. Not a whole lot of movement. Like I said, there's not much in the way of economic news. One thing you can look for later today, the beige book. So the beige book will be out at 2 p.m. If you're not familiar with the beige book, what it is it's basically the Fed providing anecdotal evidence about the economy 2 weeks before a meeting. So it kind of gives investors a little bit of an idea of one of the things they're going to be talking about in their meeting. So these beige book reports come out normally 2 weeks before a Fed meeting. And a different Fed district bank will compile the evidence on the economic conditions from all of the 12 Federal Reserve districts. So basically they're just taking turns coming up with, the economic conditions in each of the 12 Fed districts. This is a very influential market event. Any Fed meeting, anything to do with the Fed, to be honest, is important because the 2 things that, in my opinion, drive the stock market is number 1, earnings. It's hard for me to say which one's which, which is more important. I think the environment, when we're talking about the Fed meetings, we're talking about the environment in which stocks can either thrive or decline. And when you get into earnings, obviously you're talking company specific, you're talking industry groups, which areas of the market are doing well, what part of the economic cycle we're in, those types of things will impact earnings, individual earnings of companies. But what the Fed's doing, is the Fed supporting the stock market, or is the Fed a headwind? And I don't think there's any doubt. There shouldn't be any doubt in everyone's mind that the Fed is helping the stock market, has been for many years. Some don't like it, but it is what it is. So whether you like it or not, you still have to deal with it. The Fed supports the market. The Fed wants to make sure the economy continues to grow. But the Fed also has mandates in terms of trying to grow toward full employment, keeping prices stable. They have a lot of different roles and different hats that they're trying to wear. But the one thing that they want is continued sustainable economic growth without too much inflation. And they don't want the economy to get too hot. So they're always playing this, little game trying to, it's almost like surfing, I think. They're trying to ride that wave in without, having some kind of big crash on the way in. But anyhow, beige book out later today at 2:00. So that will be something to at least keep an eye on. Tomorrow, jobless claims. And then on Friday, we get the PPI. So that is inflationary data that the Fed, this will be the latest PPI data. Next week, we'll have the CPI information out. That will obviously have an impact on what the Fed has to say as well. So those will be a couple of big reports to watch. All right, moving on. Let's talk a little bit about gold. I wrote about gold in Daily Market Report yesterday, and I try to take a look at it once in a while. I'm not a fan of gold, and I think anyone who's followed me knows that. I'm looking at, when I look at potential investments, I always look relative to the S&P 500. And I'll show you a chart in just a couple minutes about how weak gold has been relative to the S&P 500 throughout this almost entire bull market, since almost the bottom, 2009. Really, I think it started about 2011. But we'll get into that in a minute. Technically, gold had a horrible day yesterday. It was down almost 2%. Got right up to a key short-term resistance here near 1840. Couldn't get through and fell back. And you can see the overall trend, even though we go through periods of movement to the upside, the overall trend has been lower. And if we look at the S&P 500 over the same period, do you see the S&P 500? Probably don't need to show you a relative chart for you to understand that gold has been a relative underperformer. I mean, we just hit a triple bottom about a month ago. We were at a 52-week low on gold. And then again, we go back to the S&P 500, and we've been going up, setting new highs every other week. So clearly gold, not a very good performer. Now, some of this in gold has to do with how the dollar's performing. And if you look back to 2011, in my opinion, that's when we essentially printed a double bottom, and the dollar has been trending higher. Now, some might argue, well, yeah, but it's been trending lower. And you could even, let me annotate this, I'll show you. You can even show where this trend line broke. See if we can get this. Here we go. So, oops, I'll pull that. Let me grab this thing right here. So you see this trend line connecting this point here in 2014 and again in 2018. You can see that broke. I mean, I'm not going to dispute it. That's a trend line break. But for me, the more important thing is, do we hold on to price support? Everything for me is always about price support. I mean, trend lines are great. Moving averages are great. All these other things we talk about, overbought conditions, oversold, all these things are great, but they're all secondary. The most important thing on a chart, technically speaking, is price support, price resistance. The absolute basic definition of an uptrend is higher highs and higher lows. So when you start an uptrend, you move up, you pull back, you move up, you get up to this high, you pull back, put in a higher low, you get up to this. We actually did make a new high here. So to me, this low becomes the most important thing. We've gotten close to it, but we haven't violated it. So as far as I'm concerned, the dollar remains in an uptrend. So if you hear me say that, you don't understand why I'm saying the dollar's in an uptrend when it's been going down now for 18 months. It's the big picture. I still see this higher high, this higher low, and then this high we actually did clear. So we do have a new high in place, although, you could argue maybe that's not a new high yet, so that we could potentially go down and set what would be the higher low. But I think enough time has gone by. When you've held a low for 5 years, 6 years, I think it becomes pretty important low. Not only that, but this low coincides with these two tops over here. So we had price resistance that was pretty clear right around the 88.5. And when we broke above it, we sailed up to 100. I think it's noteworthy that when we come back to 88.5, which is right to that double top. So there are multiple reasons here, but the dollar to me is in an uptrend unless we fall below 88.5. If we do that, then I think we've got an environment that is much more inviting for gold. Now, when you look at gold, here's the gold relative to the S&P 500. So remember, I showed you the two charts, last year of gold, the last year of the S&P, and you can kind of see that it was underperforming. Well, here is the visual for the last year. You can see gold going straight down, not only going down, but setting a new relative low that goes back all the way to here, which was back at the end of 2005. We haven't been at this level on a relative basis in 16 years. That's how bad gold has been. And yet I still see folks writing about how gold is, in this uptrend, and it's nice, and it's awful. It's awful relative to the S&P 500. And so any money that you've had committed to gold for especially the last 10 years, has just been holding your portfolio back. I mean, I understand fully diversified portfolios want to have a little piece of gold, but while the dollar remains in an uptrend, while the stock market remains in a bullish trend, while the VIX is declining, all of those things generally send gold lower on a relative basis. Now, you can see over the course of the last year, that's CRB. I just have the relative. But the CRB, which is, you've got to consider energy and gold, silver, all kinds of different commodities. But the CRB has been relatively flat, up slightly over the last 18 months, while dollar has been going down. Normally, that bodes very well for commodities. But even when we saw the drop in the dollar from 2017 to the beginning of 2018, that was a pretty steep drop, 103 down to 88.5. That was a very steep drop. And on a relative basis, commodities underperformed during that period. Gold underperformed during that period. Silver underperformed during that period. So even when the dollar has been weak, it's almost another signal that the dollar is not going to continue to be weak. The market's telling us, based on how gold and silver and commodities in general have been trading, that the dollar is more likely to go higher. Or maybe the market is simply just waiting for a breakdown in the dollar. That would be another possible explanation as well. All right. One other thing I like to follow with gold is the relationship with copper. And I've shown this before, but just in case you haven't seen it. When copper is rising relative to gold, this up here is simply the copper contract divided by gold. Copper divided by gold. That's all this is up here. When it's going up, the S&P 500 tends to do very well. When this ratio is going down, the S&P tends to be flat or goes down. In a secular bear market, we would see the S&P going down when this ratio is going down. Here, the ratio is going up. Once again, another big spike in the S&P. Here we go down for an extended period, and essentially for two and a half years, almost 2.5 years, we go sideways. We ended up going nowhere. Now we're rising, and you can see this is continuing. I would say we're still in an uptrend. I mean, we go through uptrends with periods of decline, some shorter than others. We go through downtrends with periods of rises. So I would say, even though we've pulled back a little bit, the overall trend here has been up. So I could annotate this and actually drag this up all the way to where we are now. So during this run with copper moving higher versus gold, the S&P has gone up almost 63%, but that's historically what the S&P does when copper is outperforming gold. If you want to know why this works, copper is a commodity that is very, very closely tied to economic conditions, global economic conditions. So when copper is doing well, demand is picking up because the economic activity is picking up. So when copper is doing well, that's normally a really good sign for our economy, global economy. Gold, on the other hand, when the economy is strengthening, gold tends to struggle. If the US economy is strengthening better than other areas of the world, the dollar goes up. That puts more pressure on gold. So it makes sense that when copper is outperforming gold, we're going to see the S&P doing well. So we want to be careful about these periods when we start seeing lower lows and lower highs printing, lower lows and lower highs printing, higher lows and higher highs. That's going to be very good for the stock market. So you can just look at this and, maybe you want to say that's a warning sign. I don't really view it, not at this point. I think it's way too early to call this a downtrend. This could be nothing more than what we saw here in 2017. All right. Let's move on to, I wanted to show you scanning. So this is more for Earnings Beats members, although if you're not a member, maybe you'll get a little bit more of a flavor for some of the things we do. But I had a question come up recently about the bullish trifecta the scan that we published and then created a chart list from it. And I just want to show you what you can do if you go in here and just select new scan. Essentially what the bullish trifecta is it's three of what we're looking for are stocks that are included in three different chart lists. The first chart list is our strong earnings chart list. The strong earnings chart list, and by the way, you can't copy what's in my account and try to post a scan in your account, because when this says favorites list is 155, this is looking at my account. My account, the strong earnings is showing up as favorites list number 155. If you don't have this chart list in your account, number one, it's not going to know anything about this chart list even existing. So you've got to download the chart list into your account and then go into your own account and pull up the chart list. If you type in what I have, it can't look into my account to see the chart list. You have to pull it up on your own. All right, so that's the first one. Now let's go down and the strong earnings chart list, by the way, is I would say our signature chart list. I mean, that's the poster child of a lot of what we do. The strong earnings chart list is every company that's beaten Wall Street estimates as to revenue and earnings in the latest quarter, that are liquid and also look good technically in my view, because that's where the judgment comes in more than anywhere else. It could be a stock that maybe isn't doing very well, but it's part of a great group. It could be a so-so company in the semiconductors, which have been a superb area, or in the internet, which has been a superb area. But that's what goes into strong earnings. Now, what goes into strong future, actually, I don't want strong future earnings. If we look for a common denominator or common stocks in these various groups and we pull up strong future earnings, we won't get any. The reason is strong future earnings includes all companies that have solid relative strength. So a scooter score that's at least 75 or 80. And looks good technically relative to its peers and so forth. So it's nice looking charts with strong scooters. And here's the caveat. These are companies that are not on the strong earnings chart list. So when this is created, any company that's on the strong earnings chart list actually gets deleted from this list. So if we run a scan and ask for every stock that's on both the strong earnings and the strong future earnings, and we try to run that scan, it's going to come back zero. It should always come back zero. If it comes back with anything, then something is wrong. Either I put the chart list together wrong, or maybe you don't have the updated chart lists. Some of those things to consider. So anyway, we want to get rid of strong future earnings. So what we're going to do, strong earnings. The other one I want to do is strong accumulation distribution. So this is a chart list that just includes from all 11 sectors, those companies that meet certain volume requirements, but that also are strong, that have strong AD lines, accumulation distribution lines. And that's judgment. I look at it, I basically just want to see price action going up and the AD lines going up. That's essentially what I'm looking for. Mostly over the last 4 to 6 months, sometimes I'll look back a year, but I want to see strong accumulation distribution. So it's a different way to look at stocks technically. Are they, being accumulated? All right. And then the final one that I like to pull up is the raised guidance chart list. Raised guidance chart list is exactly what the name implies. These are companies that when they reported, or they don't, not even when they reported, they could be raising guidance in the middle of a quarter. But companies that have raised guidance will be on our raised guidance chart list. So if I run a scan of these 3 chart lists, what I'm looking for are companies that meet these 3 criteria. They fit into each of these 3 chart lists. So any company that comes out of this scan will have beaten earnings and revenue estimates in their latest quarter. They'll be liquid. They'll be strong, either individually strong relative to their peers, or maybe their peers are very strong. But those things are going to be in that stock. Also, any stock returned is going to have a very strong AD line. So it's going to appear as though they're being accumulated. And then also any stock on this is going to have their guidance raised at some point over the last quarter. That's a pretty powerful group right there, I think. So I called it the bullish trifecta chart list. So all you have to do is run the scan. And right now there are 80 stocks. Think about that. You've narrowed a lot of stocks out there to companies that have beaten earnings, that have strong AD, also beat revenues and earnings per share, strong AD, and they've raised guidance. That's a pretty powerful combination, and there are 80 of them. And then all you have to do, and I'm showing everyone this because I got a question that was asking me, when I was going to run the bullish trifecta chart list again, and how I do it. And so this is the reason for it. This is why I wanted to go through and show everyone. But then you can just store in a new chart list or replace the existing chart list. I'm just going to set it up. We can call it, I don't know. I'm trying to think of the numbering system on this account. 0120 maybe. I don't know. That should be somewhere. Bullish trifecta. All right. Now I'm going to hit OK. I probably named it the same as another one or the other. Yeah, actually 119 would have been better. But anyway, it's right in here with my list. But now what I can do is I can look at this list and immediately see what these stocks did yesterday. Maybe some of them were down yesterday. Here's several of them while the market was overall was down. But here's many of them. And if you're familiar with stocks and you look at them, you might see some pretty good names. Look at these scooters in here. Another way to do this would be to rank by scooter. So find some of the best scooters that have pulled back. PRFT. I mean, again, we're looking at stocks that should be among the best of the best in terms of fundamentals and technicals. So, looking at a stock like PRFT, Proficient, pull that one up. So, yeah, it's a little extended. Had a bearish, that's a dark cloud cover candle. So we might see a little bit more weakness on this one short term. But what we might see when we look at these pullbacks, maybe we're getting a 20-day test. Could be some things that are, tradable. How about EPAM systems? Bearish engulfing candle with a negative divergence. Now, this one I would not have any interest in at all. When I see a negative divergence and a bearish engulfing candle, I think this is a stock that will see additional weakness in the near term. Wouldn't be surprised to see it break that 20-day and possibly even go all the way back down into this gap support area and test that 50-day. That'd be another $40, $50 to the downside. So, I'm not, just because they're pulling back doesn't mean they're great opportunities. But you should be thinking, hey, if it does pull back a lot because of that negative divergence, if I could get that stock maybe at 575, be a great entry into it. All right, let's keep moving on here. Wanted to pull up a couple of earnings. So this is UiPath. And I'm going to just pull up the symbol summary. Actually, 9:30 right now. So let's just pull these up, see if we can get real time quotes. Still not opening on this one just yet. Let's come back to this. Let's see what Coupa Software is doing. Coupa opened up $7. And it was definitely showing some strength recently. I still think some overhead resistance sits up here on Coupa at about 280. So we got to watch that. Smartsheet reported. By the way, all these companies reported better than expected results. Smartsheet reported better than expected, but was right up against resistance, pulls back. I think this is an opportunity actually on a stock that had been performing extremely well. I think on a, don't have it on here on a relative basis, but you can see the AD lines at a new high. On a relative basis, I think we are about an 8 or 9 month relative high from what I recall. They beat top line. Now, I didn't see what their guidance was, but assuming they beat top and bottom line and maybe raised guidance, I think these pullbacks are buyable. So this will be an interesting to kind of just keep an eye on and see what it's doing. 72. Yeah, it's still pulling back a little bit there. Let's go back to Path, see what that's doing. Path went down. So Path reported a penny profit, expected to lose 6 cents. And the stock went down to a new low from its IPO. KFY reported this morning. Korn Ferry, not seeing what is showing is up 72.97. Now that's yesterday's candle. Let's see if we can pull up it. Okay, so it is up. It's up 4%. This is just a 5-day, 10-minute chart. But you can see it opening up at 76 for whatever reason. It's not showing on the daily chart. But it is breaking out on the report. They reported $1.37 versus $1.07. All right, let's wrap up with the three you must see. I'm going to start off with, or I'm going to show you these three. Well, no, not these three. I was going to show you the three Dow stocks, the three worst performing Dow stocks from yesterday. So let's do that. We're going to start off with 3M, which is continuing to lose. You can see it actually on big volume, lost support from these last two lows. This is not looking good to me. I would expect, I mean, we could see a bounce at any time, but I don't think we've seen a low yet on 3M. I think we're going to continue to move lower, probably down toward the low 170s would be my guess, maybe to challenge this area over here. Next up, Honeywell. Honeywell also not a good performer yesterday, rolling over. See that PPO rolling over. I think mostly, though, we're just sideways consolidating. I think we have an uptrend. I think the highs right in here at about 233 to 235. That's your resistance level. I think this is your key support. Potentially, we could go down another $9, $10 until we reach that support level. But I still think the overall trend long-term is higher on Honeywell. And then the last one I have for you is Amgen. Amgen's interesting because as we move lower here, you can see the PPO has now turned back up again. Yesterday, we set a new low intraday, but the daily PPO is starting to turn up again. So I'm wondering maybe if we're hitting a key bottom. And if you look across here, you see three lows between 215 and 220 in the last year. And we went just below 220. So I think Amgen's getting close to a potential bottom. If you'd prefer trading stocks that have been weak and you feel like you're getting good value, then I would be looking at a stock like Amgen. And I would maybe think about buying in a couple of different areas, maybe down to that 215 level, and then maybe using 205 as a closing stop, giving it room. But I think Amgen starting to look interesting, especially with that PPO starting to turn higher, a little whiff of a positive divergence there. Always looks good. All right, let's see what's going on here with the market. We got the Dow down 63, S&P down 10, NASDAQ down a little bit more on a relative basis, down 38 today. Small caps and mid caps both down a little bit higher on a percentage basis. So market getting off to a little bit of a slow start. We'll see what happens. I would not expect a huge sell-off. Like I said before, I mean, the NASDAQ, maybe 1-2% tops is all I would be looking for at this point. Just really haven't seen a whole lot to suggest a big sell-off. And it seems like the bulls come in just about at every opportunity. Do keep in mind 2:00 today, beige report comes out. That will be something the market will be watching. We could get a little bit of a knee-jerk reaction from that, but otherwise should be same old, same old. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV, which you can access. Go over to Stock Charts, click on this link, 9:00 tomorrow morning. I will be, it'll be a recorded Trading Places live show. I'll probably record it tomorrow morning before 9 a.m., probably around 7:30. That's what I normally do. But anyhow, check that out tomorrow morning, 9 a.m. Your next Trading Places live here at Earnings Beats will be next Monday at 9 a.m. Everybody have a great rest of your week and happy trading.